Okay, so picture this. You're trying to run a business, but the value of your money is changing not just by the day, but maybe even by the hour. How on earth do you know if you're actually making a profit or just treading water? It's a massive problem, right? Well, today, we're diving into the special accounting rulebook designed for exactly this kind of chaos. It's called IAS 29.
So, here's our game plan. First, we're going to look at what happens when money just stops making sense. Then we'll pin down what hyperinflation actually is. From there, we'll introduce the rulebook itself, IAS 29, and get into the nitty-gritty of how it all works. And finally, we'll wrap up with why this standard is so incredibly important.
All right, let's set the stage. We're talking about a world where the very foundation of accounting, a stable currency, completely crumbles. It's like trying to measure a room when your ruler keeps stretching and shrinking. Nothing adds up.
Let's really think about this. Say you sell a widget in January for $100. By December, you're selling that exact same widget for $10,000. On paper, your sales have gone to the moon, but have they really? Nope. Not if that dollar is now worth a tiny fraction of what it was. The numbers are telling a story for sure, but it's a complete fantasy.
And this gets right to the heart of it. The official standard, IAS 29, says it plain as day. Financial reports in this environment are not just unhelpful, they're actively dangerous. They're misleading. Trying to compare this year's results to last year's? You might as well be comparing apples to, well, to dust, because that's what your money has become.
So how bad does it have to get before we call it hyperinflation? Well, let's move on and see how the standard actually defines it. And what's really interesting here is that it's not about hitting one specific number. It's more about looking around and recognizing the telltale signs of an economy in a nosedive.
These are the signs you can literally see on the street. Nobody wants the local currency. People are scrambling to buy physical things, real estate, goods, anything, or a more stable foreign currency like the US dollar. The moment you get paid in local money, you spend it, because you know it'll be worth less tomorrow. You walk into a store, and prices might be listed in another currency. It's an economy running on fumes.
Now, while there's no single magic number, the standard does give us this one huge quantitative red flag. If your country's total inflation over just 3 years is getting close to or blasts past 100%, yeah, you're definitely in hyperinflation territory.
Okay, so we've seen the chaos. Now, let's talk about the solution. This is where International Accounting Standard 29 steps in, designed to bring some kind of order back to the madness.
Think of IAS 29 as a kind of universal translator for money. Its whole purpose is to take all these transactions that happen throughout the year at wildly different currency values and translate them into one single consistent value, the value of the currency on the very last day of the reporting period. It gets everyone speaking the same financial language again.
And why do all this? Well, it boils down to one simple, crucial word: comparability. By restating everything into today's money, an investor, a manager, anyone can finally make a real, meaningful comparison between this year and last year. It brings the whole point of financial reporting back from the dead.
All right, so let's get into the mechanics. How does this whole restatement thing actually happen? It's a really fascinating process, and it all comes down to one fundamental difference. The standard basically splits everything a company owns and owes into two buckets. First, you have monetary items, think cash or money people owe you. Since they're already stated in the current end-of-period currency value, you don't touch them. But then you have non-monetary items, things like buildings, equipment, inventory. A factory you bought 10 years ago, its original price is meaningless now. These are the things that need to be updated.
And here's the three-step recipe for how it's done. First, you dig up the original price of that building you bought 5 years ago. Step 2, you grab a general price index, which is basically an official inflation calculator for the economy, and you find out how much value the currency has lost since you bought the building. And step 3, you apply that change to the original cost, and voila, you have the building's value in today's money.
But now we get to the most surprising part of this whole standard. It's something that feels completely backwards at first. It forces companies to calculate this thing called the gain or loss on net monetary position.
Okay, this is where things get really wild. In a hyperinflationary economy, if you're holding a big pile of cash, you are actively losing purchasing power every single second. So the standard makes you report that as a loss. But here's the mind-bending part. If you're holding a lot of debt, you actually report a gain. Why? Because that loan you took out years ago, you get to pay it back with today's nearly worthless money. It's a bizarre but logical outcome of the economic chaos.
So let's bring this all home.
After all that work, why does this standard truly matter? What's the real-world impact of untangling this financial mess?
Simply put, it makes financial information useful again. It peels back the layers of inflationary distortion and gives everyone a clear, realistic picture of a company's financial health. For the first time in a long time, investors, lenders, and managers can actually make smart decisions based on reality, not on financial fiction.
And this isn't some secret formula. The standard demands total transparency. Companies have to come right out and say, hey, just so you know, these numbers have been restated for hyperinflation. They have to explain their methods and even name the specific price index they used. It's all about rebuilding trust through honesty.
So let's just end with a final thought here. A standard like IAS 29 is an incredible tool, but it's also a powerful reminder that value isn't some fixed, concrete thing. It's a concept, a story we all agree on. And when that story breaks down, we have to invent a new way of telling it just to make sense of the world. It really makes you wonder, what do we consider truly valuable in the first place?